So I'm recording the workshop. So this will be a workshop that will be recorded and put on our website. So if you miss any parts of it or you want to go back to it, you can always view it on our events page at homeownershipoc.org. And if you do have any questions, feel free to put them in the chat box. We'll be answering questions throughout the workshop. And we're happy to answer questions. We want this to be a very interactive, informational workshop, so you get the most information out of it. So we'll give people just one more minute and then we're going to go ahead and get started because I know your valuable time is very valuable. And yes, we want to get this done and over with and learn a lot of information about various first-time buyer programs as well as down payment assistance programs. We're going to be talking about some of the very new down payment programs that are available that are like hot off the presses and what's really working in today's market. So let me check my time. Yeah, looks like it's about time to start. So welcome everybody. This is our homebuyer educational workshop presented by Homeownership OC. We are a nonprofit HUD-approved housing counseling agency, and we love doing these workshops. We love learning more about the different programs that are out there, learning about down payment assistance. And you've got some really great presenters today. So myself is Connie Dertarosian. I'm the Executive Director of Homeownership OC. We also have Helen Tran, who's our Senior HUD Housing Counselor. So Helen, if you'd like to say hello.
Hello, my name is Helen Tran. I'm a HUD certified housing counselor with the Homeownership OC.
And Helen's been doing this for quite a long time, maybe over 20 years. So she's the resident expert and knows pretty much everything about all the down payment programs and first-time buyer loans. And she's actually the one that will probably be working with you to qualify you for these great programs. So both Helen and I have over 20 years experience working in this industry for nonprofits. And we also have with us Doris Perdomo, who's with BMO, and she'll be our lender partner today. So if Doris, you want to pop in and say hello.
Yes, absolutely. Hello, everyone. My name is Doris Perdomo, and yes, I work for BMO Bank. I am a CRA mortgage banker. What that means is that I help you find resources in combination with Miss Helen. So we try to find just different grants, down payment assistance programs that you can use for your future purchase. I'm excited to be here. So thank you, ladies, for having me here.
Excellent. Thank you, Doris. And you're going to hear a little bit more from Doris a little later. She's going to go over the mortgage process, the loan process, and talk a little bit about down payment assistance programs and how they can be layered together and help you in the best way to get into homeownership. So as I said, we're a nonprofit HUD-approved housing counseling agency. Our mission is to promote and preserve the dream of homeownership, and we do that through outreach, education, counseling, and financing. We were started in 2007, and we've done way over 400 educational workshops, educated over 38,000 individuals on homeownership, credit, foreclosure prevention, avoiding real estate scams. And we do partner with the Fair Housing Foundation on rental and fair housing educational initiatives. Our website, homeownershipoc.org. We're also on YouTube. We're on social media. We're trying to get the most information out there to make sure that you all have the most information available and latest information that's available. So if you have not already, please do complete our online intake form. In order to get a certificate, which you will be issued after this class, we do need your intake form, and we do need you to schedule a one-on-one session with a counselor. So the first step would be taking this class. Then you would complete your online intake form. You would sign up on our portal. complete the intake form, and you can go back to it. We'll have you set up an account, verify your email, go back to that account, enter all of your information as best you can. And once we receive it, we will schedule a one-on-one counseling session with you. Once you do that counseling session, then we will issue your certificate, and we're happy to send it to you and to your lender if you're in the escrow process. So complete the workshop, do the intake one-on-one. Those three things, you get your certificate. Now, what is that? You're going to read some of our counseling agreement. Basically, we're providing you no cost counseling. So we're going to give you an action plan. We expect you to follow that action plan. And if something comes up and you can't continue with the counseling, just let us know. Your information is kept private with us, so we don't share your information with anybody unless you authorize us to share that information. So everything stays safe with us, but we do use it for our reporting purposes and for our grants that we receive. So be sure to complete that intake form if you haven't done that already. And if you have, your one step is done. So let's jump into the workshop. So I'm going to go over credit, budget, spending plans, savings, and then we're gonna hand it on over to Doris, who's going to go over the mortgage loans, different types of loans. Then we'll do a little bit on down payment. We'll take a little bit of a break, and then we'll come back and finish it up with our final session on shopping for a home, working with a realtor, protecting your investments, and all that good stuff. So if you do have questions throughout the workshop, feel free to put them in the chat. I'll be happy to go through that periodically and answer any questions. So let's talk a little bit about homeownership and why it's important, some of the advantages, some of the disadvantages of it. Number one is control over your environment. So you're not renting from a landlord. You'll have more control. If you want to paint your house, you can paint your house. You want to fix up your house, you can fix up your house. There's more stability. Of course, there's incredible tax benefits. And the one that I like the most is it helps you build equity and assets for yourself and for your family. It's also an appreciating investment. So over the years, it's going to definitely increase in appreciation. And it is, I think, the number one way for you to build wealth for your family and for yourself. So just think, how long would it take you to save $100,000? Well, in a couple of years, it's certainly, you could have $100,000 in equity on a home that you've purchased. Of course, some of the disadvantages are there are no guarantees. There is decreased mobility in that you would have to sell your home. Maintenance and repairs is on you. There are some monthly costs, but it really is a long-term investment. But as I say, I think definitely the advantages outweigh the disadvantages. If you're able, with rising rent costs, I think if you're able to squeeze the home buying, it's really the best way for you to build wealth. And it is a great investment. So of course, as a renter, you're usually just responsible for your utilities, but as a homeowner, you're going to have some additional expenses: water, trash, property taxes, homeowners insurance, repairs and maintenance. If there are HOA fees or Mello-Roos, you'll be responsible for that as well. So that's why it's really important to get educated on the process and know kind of what are these extra costs going to be, so that we can make sure that you're prepared for it and that you have enough money to go into this transaction, so that it's sustainable. So let's say you're going to meet with a lender. They're going to look at your affordability. So what is that based on? So of course, they're going to look at your income. They're going to look at your credit score and your history. It also is very dependent on what are the current mortgage rates these days. And I'm sure Doris is going to go over that during her presentation. Down payment, that's a big one. I would say majority of our clients don't have the money for a down payment. But the good news is there are many different programs available offering up to 120, 110, 50,000, $20,000 to help you get into home ownership. We're going to go over all those programs. The type of home you're going to buy. So if is it single family, condo, is there an HOA fee? We have to take all those things into consideration. And of course, your current lifestyle and future plans. And then there's going to be closing costs and fees associated with the home purchase. And we're going to go over all that. So what are the steps? I like to break it down into 10 steps, basically. So 1, prepare for home ownership, which is what you're doing right now. 2, you're going to determine how much you can afford. 3, apply for a mortgage loan, see how much you get approved for. You'll get your pre-approval. Then number 5, you'll decide on what type of home you'd like. 6 is you'll go shopping. That's the fun part, going shopping for a home. 7 is making an offer or counter offer. 8 is get a home inspection. 9 is complete the tasks that are required during escrow. And then 10 is close the loan. You get the keys and you get to move in. So those are the 10 basic steps. So we're going to go over all that whole process during this whole workshop. We're going to kind of break it down into certain little sections here. So just know that throughout the process, we are here as a nonprofit to help coach you after the purchase. If you have questions, we're here for you for post-purchase counseling. We're going to issue that HUD certificate. We're going to help you through that whole home buying and guide you through the process and provide you one-on-one counseling. So let's talk about how do we prepare for home ownership? So first thing we're going to do is we're going to ask you to do a budget. When we ask you to complete that intake form, we're going to ask you to complete a budget, or a spending plan is what I like to call it. We're also going to ask you to track your income and expenses, right? And we may have to review those things and decide what's necessary, what maybe areas that you can trim, or where you can start saving, because you are going to, even if you do get that down payment assistance, you are going to have to bring some money into the game. So we want you to boost your savings, set patterns to boost your savings potential. Know your triggers. Like if you know, hey, on Fridays I get paid, I like to go to the mall, I like to do some shopping. Maybe you can, switch that habit up and do something else where you're not spending money, right? If homeownership is your goal, then you may have to adjust some of those things. So I'm going to ask you guys now, when I say spending plan or budget, what comes to mind? Is it a negative or is it a positive? And what are some of the benefits of tracking your spending? And let me know, do you use a budget? Do you guys have a spending plan? Do you know kind of how much money is coming in, how much money is going out? And are you saving? There's a lot of great tools that are out there. So I encourage you to put that information in the chat and share it with all of us. I know a lot of the banks are offering that with your checking accounts. But for the most part, people have a negative connotation when we talk about budgets. So I like to call it a spending plan. And with a spending plan, it's basically figuring out how much money is coming in and how much money is going out. So if I make $3,000 a month, but I'm spending $3,200, that's not a sustainable budget, right? So and when it comes to home ownership, we have to think about savings, because we don't want you to be completely broke once you buy this home. We want you to have money if you need to make repairs. So we're going to need to have a savings plan too. So what does that do? It really helps you to estimate what you can afford to pay in a mortgage. It helps you identify where you may be able to cut expenses. maybe develop a stronger loan application, prepare for maybe the additional costs that you may have with homeownership, and it will provide you motivation. So I always tell the story of a client who came to us and she was making $10 an hour, okay, at a nonprofit. And she goes, "Hey, Connie, I want to come to your class." So she came to our home buyer class and she goes, "I can't buy, making $10 an hour." And I said, "No, but if you pay down all your credit card debt and you get maybe another job where you're making more money and start saving, you certainly could." So sure enough, she got a better job. Her husband had a really great job and was making good money. She paid off all her credit card bills and she was able to buy a home that she thought there's no way she could buy a home. And she thought she needed down payment assistance, but actually, when she was on her savings plan, she was able to utilize her savings and she didn't even need down payment assistance. So, sometimes you need that little extra help, but sometimes you don't. So sometimes it just takes a little bit of a motivation. So how do you guys track your savings? And I mean track your expenses. You can do it in a notebook. There's a lot of online tools. You could keep your receipts. Sometimes the bank will offer that to you. There's a lot of different ways that you could track your expenses. Um, there's one called mint.com that I think it's now called Intuit, that is really a great tool to help you track your expenses. I know Experian and some of the other credit places also have great budgets. We too, can help you with the budget, and that's one of the first things that Helen's going to do when she meets with you. She's going to look over your budget and see like where's your money going, and then have a conversation with you. So establishing a savings and spending plan, it helps you determine how much money are you making every month. It'll also help you calculate your monthly expenses. And then we see, is there any extra income? And then you can review your savings and spending plan and make adjustments to your monthly income and expenses based on that plan. So I want you guys to jot down on a piece of paper. We're gonna do a little exercise here. We're gonna figure out what is your net income, or the money you earn after taxes or payroll deductions have been taken out. You're gonna write that down. And you should have done this if you've already completed the budget. You would have done this in our budget section, but we're gonna just jot it down and kind of figure out what our income and expenses are right now. So if you live with somebody else, let's take the whole household income and we're going to jot that down for yourself and your spouse or your partner, whoever's living in the household. If you have kids who work and they're contributing, write down all of their income and then add that up. And then let's go over some very basic expenses. Cell phone, of course, right? Utilities, water, trash, food, cable, internet, car payment, car insurance, gas. Kind of jot down those expenses. And credit cards, of course. And for those, you can just put whatever the minimum monthly payment is. And let's add those up. So let's do this little exercise real quick. I'll give you a minute to do that. And then let's see what we come up with at the end. We're going to total out our income. We're going to total out our expenses. Then we're going to subtract our expenses from our income. And hopefully at the end of this exercise, we are in the positive. And it doesn't have to be exact. So like insurance, if you pay it quarterly, you can just kind of figure out what is that per month and put down the monthly amount. So we're going by the 30-day estimates. All right, so how are we doing on that? So you got your total income. We jotted down our little expenses. And how are we all looking? Hopefully, at the end of this exercise, you all are looking at a positive amount, right? So let's say we're using my example. I make $3,000 a month. My expenses are 2,800 and I've got $200 extra per month. Well, that's a great budget, right? But maybe there's ways that we could look at, and maybe we could boost that $200 to $300. And we could put some of that into a savings account. So it's not a bad idea if you're looking to buy a home to put a separate account, not just a regular savings account, but this one is just one that you're not going to touch until you buy a home. Let's figure out what we could put in there and make a separate savings account just for home ownership. So as I said, when you're looking at your expenses, there's going to be two types, fixed, flexible, and then periodic. Well, three types actually. So fixed would be your monthly rent or your car payment. Flexible could be your groceries or eating out, vacation money. And periodic could be something like your auto insurance. So fixed expenses, we can't really do too much about. The periodic is usually a set amount, but the flexible ones are something we could definitely look at. So let's say, for example, you're spending $500 a month on groceries. Perhaps we could look at, are there ways that we could cut down on that? Maybe buying in bulk, going to Costco or something, and, buying things in bigger packages and freezing stuff to cut down on some of those expenses. Or perhaps we're eating out and we could cut that down to, once a week instead of twice a week and save some of that money. So it's a good idea to look at your spending plan and kind of figure out where is your money going. Because I think that's one of the first things that the counselor is going to do is look at what is your income? What are your expenses? How much extra do we have? And do we have any money in the bank? Do we have any extra money? So hopefully you were able to do that little exercise. There's lots of little spending plans and savings tools online if you like the apps. Track it. I know some people use an Excel spreadsheet. Whatever works best for you is really the best thing for you to utilize, right? And the other thing is everybody in the household willing to follow this plan? So, if you have kids, I know how that goes. Sometimes they're always requesting money for this or that. And hey, if you want to put some money aside for, extracurricular activities or things that come up, once that money's gone, you say, sorry, there's no more money left. No. So it's really important to stick to your spending plan and track your spending for 30 days. Really see where's your money going, because sometimes there's things that we buy that we don't even realize. We're going and getting a Diet Coke at 7-Eleven, or we're going to Starbucks and having a coffee once a week. If you add that up, it ends up being quite a bit of money. So set a goal, track your spending for 30 days, set up your home buying action plan, work with your counselor, maybe set up a special home buying savings account that just has money that you're gonna, whenever you get extra money, like let's say for instance taxes are coming up, you get a big tax return, you could put that money in there. So it's important to boost your savings, pay yourself first. Maybe you get some money for your birthday or whatever it may be, always put some aside in a savings account. You can look for additional funding, maybe getting some side gigs or extra jobs, overtime. You could put that in and boost your savings. And as I said, tax returns is really a great way to boost your savings, if you really are, dedicated to buying a home. So some money management tips, of course, we need to make sure we're paying our bills on time. We want to keep our credit score as high as possible. And that's another thing that Helen's going to talk to you about. If it's low, don't worry. We can help you with improving it, boosting it up and getting it to the highest score possible so you can get the best rates. Create that spending plan, stick to it. So we're going to go a little bit into credit. And as I said, any questions come up, feel free to put them in the chat or the questions box. I'll be happy to answer them. Credit is really an x-ray of our financial health. So lenders are more likely to give you a loan if you've handled past borrowing responsibly. A higher risk loan from the lender's perspective will mean you'll have a higher interest rate. So that makes sense, right? If you haven't paid your bills in the past, the odds are you're probably not going to pay your bills right in the future. You're going to have to prove that you know how to handle credit and you can boost that credit score up. You will definitely save money on the interest rate with a higher FICO score. So we're going to jump into that and talk a little bit like about now this is just easy math. Okay, so let's say we have a 30-year mortgage of $250,000 and we're looking at credit scores, right? So we're going to say on this chart it will basically tell you if the lower your credit score is, the higher the interest rate is that you're going to pay. So for instance, if you have a 5.6, if you have a 620 FICO score, you're going to pay a interest rate of 5.684, which is about $14.50 a month, versus a 760 would get you a lower 4.096 credit score, and your payment's going to be about $1,200 a month. So it makes a big difference. So we're going to try and get you up as high as possible before you go meet with that lender. Before you go, we're going to have you pay down your debts. We're going to help you improve that score because we want you to have the highest score possible. So there are 3 credit reporting agencies: Experian, TransUnion, Equifax, and your credit report will be held at 3 of those reporting agencies, and they will be merged together to get your FICO score. So it's really important that you look at your credit report. You do have the right to a free credit report from each of the 3 bureaus. It used to be once a year, but now it's once a week. So you can go to Equifax, Experian, TransUnion. If you go to annualcreditreport.com, you'll be able to pull your credit report with all 3 of those bureaus and see what's on it. There might be things that are on there that are, the credit reporting agencies do make mistakes, especially if you have a very common name like John Smith or Juan Martinez. Very common for them to make mistakes, senior, juniors. So it's important for you to look at your credit score and know what's on there. Also, there's a lot of identity theft and things going on, so you really want to look at your credit score. Annual credit report is a great place for you to go and look at it. It does not provide a credit score for free, but many of the other ones, Experian, we can help you with that as well. We have some credit tools to help you look at your credit score and look at your credit report, and also give you some tools so that you can improve your credit. And we have access to some of the Experian credit tools that will let you, let's say you're at a 600 and you want to get to 620 within 3 months. You can go online to our credit tool and it will tell you what you need to do in the next 3 months. Okay, there are some other tools like myfico.com, which allows you to purchase all 3 credit scores. Credit Karma is another one. Credit Sesame. Bankrate is a great website for you that allows you to get your FICO score for free, but also you can shop for credit cards. So if you want to say what's the one with the lowest interest rate or no annual fee, you can shop for credit cards on there if you're trying to reestablish your credit. So there are 2 types of credit reports. There's a soft pull or a hard pull. So the soft pull is one that does not affect your score. It's a consumer credit report. So all these these tools that we're talking about, that's not going to impact your credit. There's also a hard pull, which will affect your score, and it is an in-file credit report. So when you apply for a loan, they're going to do a hard pull. When you apply for an apartment or to buy a car, they're going to do a hard pull on your credit. So that will impact your credit. The ones that we do does not affect your credit score. Okay, it's just more for educational and counseling purposes. So how do we come up with those FICO scores? It's based on 5 categories, okay? The higher scores, of course, are the better scores, and most consumers are between 300 and 850, and a higher FICO score means you'll likely pay lower interest rates on a loan. So what makes up the score? 35% of it is payment history. 30% is amounts owed. So that right there is 65% of your score. How you pay your bills and your payment history and the amounts owed. So those two things right there can really help you boost your credit score. And we're going to talk about that. Length of credit history is 15%, and then new credit and types of credit used are each 10%. So again, payment history, amounts owed, biggest chunk of it. So payment history is 35%. So avoid closing accounts with positive payment history. Keep those open. Now, I know that they like to close accounts if you don't use them. So you may have to use them every once in a while just to use it and pay it off. Pay it off at the end of the month. You're showing you're still using your credit, but you're showing you're using it wisely. Keep making payments on time even if you're only making the minimum payment. Of course, I don't want you to just make the minimum payment. I want you to try and pay that off at the end of the month, or we'll figure out a payment plan so you can pay it off in 3 or 4 months, because I don't want you to have to pay that extra interest that's on that credit card. Amounts owed is 30%. So use 30% or less of your available credit limit. So what does that mean? So let's say I have $1,000 on a Target card. That would mean I'm not going to charge up more than $300. And so that would be at 30%. So you want to keep it under the 30%, or better yet, pay it off. Pay it off at the end of the month. So those are some tips right there that can help you boost your score. New credit is 10%. So if you're going to be shopping for something, do it within a 14 to 30-day window. New lines of credit, purchasing furniture, co-signing can definitely negatively affect your credit score. So don't do that, especially when you're in the home buying process. Your credit report should reflect current and accurate information, accurate monthly payments, which of course can affect your debt to income ratios, which Doris is going to talk about that a little bit later, but it's really important that all the information that's on your credit report be accurate. You can dispute stuff that's on there if it's inaccurate. Very easy to do through annualcreditreport.com. If you're in lender approval, if you're already working with a lender, always get the lender's approval before making any changes to your credit profile. So don't go out shopping for that new furniture and buying a new car. That won't work, because we basically approved you on the credit that you have. What are some tips that we have to help you boost your credit? Pay your bills on time. That's the one thing that's very, very important. If you've missed payments, get current, stay current. Just be aware that paying off a collection account will not remove it from your credit report. If you're having trouble making ends meet, contact your creditors, work out a repayment plan, or see us and we can help you with credit counseling. Now, amounts owed, keep your balances low on credit cards and other revolving credit, or better yet, pay it off. Pay it off at the end of the month. Pay off debt rather than moving it around. Don't close unused credit cards as a short-term strategy to raise your scores, and don't open new credit cards that you don't need just to increase your available credit limit. New credit tips: do your rate shopping, as I said, within a 30-day window. Know that you can reestablish your credit history if you had problems in the past, and note that it's okay to request and check your own credit, and you should be doing this at least every 6 months. Okay, so we're gonna, if we haven't done it already, we're gonna go ahead and look at our credit. All right, so any questions, feel free to put them in the questions in the chat box. I'd be happy to answer questions for you. You guys are awfully quiet tonight. All right, so we're going to do a quick little activity. I'm going to give you 3 scenarios. Susan, Jonathan, Maria. You tell me, who do you think has the higher credit score and why? All right, first scenario. Susan, she has an annual income of $31,750, car loan for $12,760. She has 1 credit card that's paid off. The second credit card has a limit of $7,500, and she has a $4,000 balance on the card. She's never missed a payment on her credit card. Okay. Then we have Jonathan. He has an annual income of $52,000. He has no car loan, no credit cards. He pays everything with a debit card or cash. And lastly, we have Maria. She has an annual income of $40,000. She paid cash for her car. She has 1 credit card with a balance of $12,000 and a limit of $12,500. She did miss 2 payments in the last year because she was traveling. So out of those 3 folks, who do you think has the best credit score and why? So we've got Maria, Jonathan, Susan. Who do you think? Feel free to put it in the chat. Or in the question box. Either one is fine. All right, we got a Maria. Anybody for Jonathan? Anyone for Susan? Susan, Jonathan, Maria. All right, remember Susan? So the correct answer is Susan. She's got 1 credit card that's paid off, which is great, right? And second credit card has a limit of $7,500, but she only has $4,000 balance on the card, and she's never missed a payment. So some folks said Jonathan. Now, Jonathan could have good credit, but it looks like he has no credit cards. He has no trade lines, which could actually be looked at as bad credit. Sometimes having no credit is like bad credit. He would need to get some credit, utilize it, at least 3 trade lines, and start working on that. So if he was looking to purchase. And then Maria, she missed a couple of payments in the last year because she was traveling. So that's going to definitely ding her score, as well as being almost to the limit of her credit card, right? So good answers. And think about your credit when we're talking about credit and what you can do to increase your score. All right, let's talk about bankruptcy. So it will factor into your score as long as it remains on your credit report. Chapter 11 and 7, 10 years. Completed Chapter 13 bankruptcies up to 7 years. And a lot of times, people are ashamed that they had to claim bankruptcy in the past, but it's really what you do after the bankruptcy, after the foreclosure, after the short sale to rebuild your credit. So I know people that have been able to buy a couple of years after that when they thought they would never be able to. It may affect your ability to qualify for a mortgage. There is a minimum waiting period with FHA and VA and other things you may have to consider. But if you've had a bankruptcy, foreclosure, short sale in the past, just know that that's not going to stop you from purchasing today. It depends on how you've been able to rebuild your credit going forward. So your credit score is going to be based on information in your credit report, and it takes into consideration all the positives and the negative information in each category. It has no memory of your last score. So even if you've had a long, ugly credit history, your score will be weighted in the favor of your latest performance. Turn over a new leaf, rebuild your credit history. It does take time. Those people who tell you, "Hey, I can improve your score in 30 days," it's a bunch of baloney, okay? It doesn't happen. They might increase your score for 30 days, but then it's gonna once they find out that that thing that was causing your score to be down is accurate and is supposed to be on your credit report, they're going to put it right back on there. So don't believe those credit repair places that charge you a fee. So you are given points for positive, points are taken away for negatives. It's very important when you're reestablishing your credit to reestablish positive credit to offset the negative, okay? How frequent, recent, and severe the negative is will impact your score as negative information. So it does season out. So as you begin to utilize your credit responsibly, you can improve your negative credit score. So the farther you get away from these negative things, late payments, charge off, collections, the more you get away from them and you replace that with positive, the higher your score is going to be. So it's really important for you to reestablish your credit and start paying your bills on time, using that credit card, paying it off at the end of the month, using it, paying it off, showing that you can utilize your credit responsibly. Very important to do, and it can be done. Now, the truth about credit repair is no one can guarantee to remove accurate and non-obsolete information from your credit report. Those people who say, "I could take off a foreclosure, I could take off a bankruptcy, I could do that," it's not possible. I assure you, it is not possible. It does take time to rebuild your credit. You could start today. No one can legally create a new identity for you, and any kind of legitimate company is going to provide a service before requesting payment. There are laws that regulate credit repair. I say stay far, far away from these folks because most of them are that Lexington law got sued, had to pay everybody money back. There's many, many people that say they're going to fight for you, but this is all information that you can do on your own. Take the money you would have used for that credit repair, pay down your debt, or get a secured credit card, start rebuilding your credit today. Those are the important things to do. Check your credit at annualcreditreport.com. You can send your own dispute letters. You can actually dispute stuff on annualcreditreport.com. If it's incorrect, you can upload documents there. It's a really great tool. We can get you sample dispute letters, and there's lots of information at credit.org. And we can help you with disputing things if it's inaccurate. There are rules and regulations and laws that guide us. The Equal Credit Opportunity Act and the Fair Housing Act. You have a right to a mortgage application being reviewed without consideration of race, religion, age, national origin, sex, or marital status. The Fair Credit Reporting Act gives you the right to a free credit report once a year, and you're allowed to dispute settlements for errors. And the Fair Debt Collection Practices Act guarantees users' rights in dealing with debt collectors. So those people who call you and harass you, they cannot tell you, I'm going to call the police on you. I'm going to show up at your house. I'm going to go to your job. I'm going to, you can say, "Hey, you're harassing me. I want everything via mail." You say, "Don't call me anymore." They don't have, they won't call you anymore. And if they do, report them. All right, so that's our credit spending budget plan. Next, we're going to go into financing a home. And I'm going to turn it on over to Doris, because I'm sure you guys have had quite enough of me.
And I get to speak about the best part.
Yes,
Mortgage.
absolutely. The fun
What
part.
what you're trying to secure, to buy your home, right? So
Yes.
once again, my name is Doris, and I am going to be speaking about, mainly about mortgage. What is a mortgage? So in simple words, it is pretty much the loan that you're trying to secure, right? It is an agreement between the lender and the buyer in which the property that you're trying to buy becomes the collateral, the guarantee of the loan, right? You will usually work with either a mortgage broker or a loan officer so that you can secure the mortgage, the loan. The mortgage broker is just pretty much like a middle person between a lender or a bank, and usually they work with a lot of different banks to help you get that loan, right? If you go to a loan officer, then that loan officer may work directly with a lender or a bank, a financial institution. So you pretty much get to work just with that one individual, particular directly to a bank. You want to go next? There you are. Okay, so I'm trying to read the top. Let me go to my own page really quick here. Okay, so this is just an example on who helps originate. So who helps get loans for, the consumer, such as yourself, right? So number one, of course, is going to be the regular traditional banks. So you can pretty much go to your bank who usually does your deposits and you can ask them for a loan. You can go directly to mortgage companies, which again is going to have loan officers that you can work with directly, credit unions, nonprofit organizations. Usually, they're going to have a lot of different resources like Homeownership OC. They are a nonprofit, so of course, they can always guide you and send you to the right partner that can help you obtain that loan. Or you can also work with government agencies. Government agencies normally are represented by the state, so they can help you get like a government loan. But those government loans are still going to be offered through like a regular mortgage company or a bank. So either way, you are able to pretty much secure that loan through a lot of different resources. Do you want to go next? There you go. So let's talk a little bit about mortgage payments. When we talk about a mortgage payment, of course, it's going to be broken down, right? The mortgage payment, of course, is going to include the payment of the mortgage, which again, part of that is going to be the principal and the interest, right? The interest is what you're securing through that bank. Of course, it's going to have property taxes and insurance. Insurance is something that you are going to get yourself. You're going to look for that insurance to whoever is either more affordable or whoever may offer a better coverage for that home. So here's a simple example of what we call it PITI. So again, that's just a representation of a full payment. So it's just in a simple example of $250,000 home, where let's just say you are putting a 10% down, and it is based on a 30-year mortgage, which is what we call a 30-year fixed term. Then it's going to include the property taxes, assuming that this is at a 1.5% of sales price, and this is how we normally calculate the property taxes. Plus, of course, the homeowners insurance in California. This is on a low end. It says $800, but this is running a little
Yes,
bit
this
higher
is an
now.
old slide. Okay, so you can feel free to put what the norm what is it normally now? I know it's gone up
I'm
quite a bit.
definitely it's gotten up a little bit. So I will say maybe $1,400 maybe nowadays. But this is more or less what it is included in a payment, right, of a mortgage. And I believe the next slide is going to have some additional items. Can we go to the next page? Okay. So I'm sure later in the slides is going to talk about the possibility of the homeowners association and all of that. So factors that affect your mortgage payment is always going to be the amount that you're putting as a down payment, right? Another factor is going to be the term of the loan. There's different terms. The most common one, of course, is going to be a 30-year fix. The reason why it's so common is because that's going to give you the lowest payment. The lower you go in the term, the higher the payment is going to be. So we don't really see too many example, a 15-year fix or a 10-year fix, because those are going to give us a much higher payment, right? Of course, something that is going to affect the payment is going to be the interest rate that you are locking with that bank or whoever's representing you for your lender. If you're buying a condo, as you know, when you buy a condo, the homeowners association fee is going to be different for every single association, right? Some may be higher, some may be lower. So, of course, that is going to affect your mortgage payment. And of course, the Melrose. For those of you that have never heard that term, Melrose it's a higher tax bracket in certain homes. For the most part, Melrose is going to be associated with a newer construction, like a newer home. So if you are considering buying a new home or a newer home, the first question I would ask is there a Melrose and what is the percentage? At that point, it may no longer be a 1.5. It may possibly be a 1.75 of the sales price or a 2%. So definitely make sure to ask if there is a Melrose in case you are trying to buy a newer home. You can go next. And so when we talk about also affordability, this is probably the very first step you're going to want to look into when you are trying to either requalify, cross, whatever you're trying to do. This is going to be your very first step. Why? Because we want to know, you want to know, what can I afford? And is that number aligned with what I feel comfortable in a payment, right? So when looking at affordability, you will often be pre-approved. You see how you are getting pre-approved for a loan. So when your housing payment and debt payments are equal to or less than a 43%. What does that mean? That just means that we are going to be using a 43% of your income as in total. And we are going to be deducting from there your housing payment, right? Which is a proposed housing payment. We are going to be deducting your monthly debt payments. That can include car loans, credit cards, child support if you have child support, student loans. So anything that appears in your credit, we are going to be deducting from that total. This is why when Connie was speaking about credit card payments, how keeping them low is going to be such a huge part of your qualification process. Because the higher those payments are, the more it's going to be deducting from that total qualification of your income. With that being said, others such as savings, investments, donations, household expenses. So we as a lender, we are not going to be deducting utilities, food, clothing, but this is also why we never use 100% of your income. This is why we use, depending on the program, we use 43% or possibly a little higher, but we also want to leave that room for other expenses that you may have. So definitely keeping your debts as low as possible is going to help through this process. You can go next.
Or better yet, pay it off at the end of the month, right? And then have
That is
none.
always, yep. And that's a good point too. I always say you have to have credit cards work for you. Now you work for the credit cards. So paying them off each month is always going to be, huge. So yes, definitely. Let me see. I'm going to use my slide on this one because I think I need glasses.
Isn't too small for you to see. It's basically saying what you're saying is the less debt you have, the more purchasing power you have, right?
Absolutely. And yes, and this is a good example. I'll give you guys an example. I just qualify a client who had two car payments One was $800 and the other one was $900. If we do the math, that's $1,700 right there. So he makes great money, but we had $1,700 worth of car payments. So at the end of the day, the difference in purchasing power, because this is talking about more purchasing power, right? With 5% of income use for paying off debt and 38% available for housing payment. So you see how you can measure the 43% housing, right? Versus a 55%. With the client paying off the one card, he was going to qualify for $100,000 more in purchasing power. So, of course, more debt, less purchasing power. If I didn't pay off the card for my client, he was not going to be able to qualify to buy a home. And so this is why we focus so much on definitely having less debt so that you can have a higher purchasing power. That $100,000 can make a big difference when it comes to, trying to buy maybe a house versus a condo, right? So anyway, next. And we were talking a lot about, the housing ratios. This is something that we as a lender use a lot. Why? Because this is going to be the percentage that we are able to use. This is an example right here. So the monthly housing cost is divided by your income. And that's how we get that percentage of the housing front and ratios. This is not even including your additional monthly payments. And if we're trying to stay at a 43%, or depending on the program, maybe some programs may allow us to use a little bit more of that income. But at this point, every single penny counts. And remember, on that housing cost is going to include the payment of the mortgage, property taxes, insurance, if there is Melrose, if there is HOA. So this is definitely how we calculate our housing ratio. And we also use, which is a good thing, we use monthly gross. So thankfully, we don't use your net income because that's obviously after all deductions of taxes, we use the gross, but we still definitely need to count every little single thing that comes up in your credit report. You can go next. There you go. And this is so this is again debt to income ratio. So this is combined everything. So the debt to income ratio is pretty much the max monthly amount that you can borrow to spend on a house, right? Your PITI, right? Plus all debts that show up on your credit report. Example, the car payment, credit card payments, student loans. And one thing that I like to mention is just because your student loan may be in a deferred status, right? Maybe for the next 12 months, that is not going to matter for the lender or the bank. We are still going to count a percentage of that total to still use those payments as part of the qualification. So definitely student loans are still going to be counted. Any credit card payments, of course. And in here, it says payments for past medical care. What does that mean? That can possibly be a medical collection. If there is, who knows, maybe a $5,000 possible collection where you are making a payment, that's still going to be counted. So every little single thing that comes up in credit report, we are going to count it as part of the qualification. Take on next. And so again, when calculating these monthly payments, we keep on going back to the 43%, which is pretty much, it's pretty standard. Again, it's pretty much subtracting all of your monthly payments from the total. And that is pretty much going to let us know what is the amount that you can afford monthly. As you can see here, $6,000 a month. If we're using 43%, right, that's going to give us pretty much the total that you can use. Now, your monthly payments, that is excluding housing expenses, plus or equal to the affordable monthly payment. So this is pretty much how we come up, and this is why we also advise you to do that pre-qualification, so that you know what is that number going to look like, and does that number work with your own personal budget as well. I know you were talking about budgeting at the beginning, and that's also going to be very important for you to have an idea on what that number looks like for yourself too.
Right. And maybe you want to talk a little bit about like payment shock and because they're like, let's say I paid $2,000 a
Mhm.
month in rent, but now I'm going to have to pay $2,700, right? Like
Mhm.
it's a shock because you're like $700 more. Oh my gosh, that's a lot.
That's a big difference in payment too.
Right.
So this is
Right.
why we're definitely we're gonna consider that as well. Like Connie mentioned, if you are paying, let's just say, $2,000 in rent, right? But your new payment may potentially be $3,000. That is considered to be what we call a payment shock. So, but at the same time, I don't know that we are 100% always on the fence of the payment shock, when we could always add also a co-borrower to eliminate a little bit of the payment shock, as long as we are able to still work with those ratios.
Hmm.
Now, when it comes to the loan to value and the ratios, so the ratio of the loan balance you owe to the appraisal value of the house. This is how we're going to calculate the percentage of how much you're putting in as a total down payment versus how much you are also going to be borrowing from the bank, right? So used during the loan approval, right? Higher LTV percentage to lower the risk and typically lower the interest rates. Now, lower the LTV ratio, higher the risk, and typically higher interest rates. So typically, yes, when you are borrowing a little bit more and a lower down payment, some programs may actually give you a little bit of a higher rate, just because those loans do tend to be a little bit riskier, right? Versus a loan where you are putting ideally at 20%, where it may give you a lower rate, right? So this is pretty much how we calculate what we call the LTV ratio. Now, to calculate the LTV, we're going to divide the appraisal value of the property by the mortgage loan amount. So this is a perfect example. If we have a $400,000 value in the mortgage, what you're borrowing from the bank is 260. So we're going to divide that 260 by the 400,000, and that means that your LTV is 65%. That means that you are putting a 35% of down payment. Now, don't get me wrong, sometimes we actually may get to that low LTV by getting some down payment assistance. I know Miss Helen is going to be talking a lot about this down payment assistance. So we actually do see a lot of these lower LTVs because of down payment assistance. So not only you get to have a better rate because of the down payment, right? But you are also getting that down payment assistance to help you with that. Do you want to add anything to that, Connie?
Oh, I was gonna say maybe you want to talk about layering, how sometimes the programs will allow you to layer the down payments.
Absolutely. And so I know that Miss Helen is going to be presenting on down payment assistance. And the best part of that, again, to get this loan to value very low, is by using various down payment assistance programs, where it may be maybe one down payment assistance, maybe 3 different grants that are being used for down payment. Some grants from the bank can be used for down payment assistance versus being used for closing costs. So in this case, we are layering a lot of down payment assistance with grants, and everything is pretty much being um, combined, right? And so you end up putting a much higher down payment. So you end up walking away with not only a lower rate, a lower loan amount while you're borrowing from the bank, right? And so what that's doing for you is helping you with a lower mortgage payment, something that is obviously making it more affordable for you and sustainable. So I cannot wait for Ms. Helen to present on all the amazing down payment assistance programs that are out there, and that again you can layer with different resources.
All right. So, before we jump into this next section here, does anybody have any questions about what was presented? And I know we went over a lot of great information. But if you do have questions, feel free to put them in the chat. It is 6:35, and I think maybe we should take a little bit of a stretch break. So maybe we'll take like a 10-minute break here, and then we'll come back and do the down payment and then finish it up. But if you do have any questions, put them in the chat or the question box. We'll be happy to answer those questions for you. And then when we come back, we'll have Doris and Helen present. Let me check real quick to make sure we don't have any questions in there. So there is one question. So how much would would we have to come up with if we get grants? And what if the seller can also help? How much is it? And would we have to, like, say for instance, we're buying a $350,000 house. How much would it be like if we're coming up with grants, and then maybe talk a little bit about like seller credits?
All those are great questions. Do you mind if I answer, Connie?
No, please do.
Okay.
Yes,
So, I mean, of
please.
course, depending on the area, depending on which program you are using, because there's several of them, right? A lot of down payment assistance programs depend on the city, depend on the county, depend on if it is a program that's coming from the state. And also, yes, seller credit is always amazing because you can use that only for closing costs of the loan, right? And then there are grants that you can get directly from a bank, which be used towards down payment, right? So I have had cases where my clients came in only with $495. So I'm not saying that this is going to be every case, but the options are there, the help is there. So to answer your question, it can possibly be as little as $1,000 if we have help from all different resources. It can happen. I hope that answered your question.
Yes, very good. All right, so we're gonna take a quick little 10-minute break. So it's 6:37, be back here at 6:47. Go stretch, get a glass of water. Since it's an online workshop, I want you guys to be paying attention. So I'll see you back here in 10 minutes, and then we'll finish it up. Thank you. All right, it's 6:47. We're back. Hopefully you had a good break. And we do have another question. When am I again qualified as a first-time homeowner? I'm divorced retiree who was once on a mortgage loan. So I'll take that one. Um, so as long as for the past 3 years you have not been on a mortgage loan or title, you would be considered a first-time borrower again. So as long as it's been 3 years, and that you haven't been on title, again, you're qualified as a first-time buyer. So we're going to talk about comparing mortgage loans. And I'm going to go quickly through this, and then we're going to get into the good stuff for the down payment assistance. So there are three different types of loans. There's government, insured, or guaranteed loans, conventional, and non-conventional. Basically, government insured is just that. It's insured by the government. So that would be your FHA, VA, USDA. Conventional is any loan that's not insured by a government-sponsored entity. And then non-conventional carry more risk to the lender investors and often offered when there's no conventional loan, like a private money loan or something like that. There's also two different types of loans. So that would be a fixed rate or adjustable. I think Doris touched on this. For the most first-time buyers, they're going to go with a 30-year fixed rate, which means it's fixed for 30 years. Fixed rate means it's fixed for the life of the loan. It's 15, 20, 30 years. Like I said, most first-time borrowers are going to do 30-year. Payment doesn't change. The cons are payment remains the same, which could be higher if it was with a different loan, or interest rates could go down, right? But you could always refinance if the rates went down. Adjustable is where the initial fixed rate period, it's fixed for a period of time, and then the rate adjusts upward or downwards depending on mortgage terms. And it's usually initially fixed for 2, 3, 5, 7, or 10 years. Initial payments may be more affordable, but payment can increase after the fixed rate period. So the only time you would really probably consider an adjustable rate mortgage is if you knew for sure you were only going to live there 3 years. There would be no sense in getting and it was a better rate. But as I said, for the most part, people are going with the 30-year fixed rate. There are special homeownership programs offered by the federal, state, and local governments, as well as private and public nonprofits. Also have programs to make homeownership more affordable. Most are targeted for low to moderate income individuals and first-time buyers, and eligibility and other requirements vary across the program. So each one has their own guidelines. Most of them have income or geographic requirements, and then Helen's going to go over a few of them in just a second. So, question for you all. So, if I make $100,000 and I have no debt, how much do you think? How much house do you think that I can afford in these crazy times that we're living in right now? No need to answer that question. I'm going to show you a quick little chart that shows you. Let's take, for instance, a $500,000 house. And let's say I'm going to put 17,500 down. So my loan amount is going to be 482. My mortgage payment is going to be 3,395. In order to qualify for a $500,000 loan, if I have no debt, I would need to make, let me make sure I'm getting the number correct here, 90,544. Now, let's say, for instance, I have $500 worth of debt. That means I have to make more money. I'd be making $108,000 a year. Now, with $1,000 in debt, we're going up to $121,700. So as you can see from this chart, this is just an example of, but just adding $500 worth of debt, that added almost what? $10,000 worth of, over $10,000 worth of income I would have to do. So hence the reason why we say get rid of your debt as much as possible. And if you have a car payment, pay it off if you can. That leaves more money available for you to purchase the home. All right, I'm going to bring Helen out. She's going to talk about various down payment assistance programs that are designed for first-time borrowers, borrowers who need maybe a little bit lower down payment, or borrowers with less than perfect credit. And
Thank
Helen,
you,
are you there?
Connie.
There you are.
Yes,
Okay, great.
thank you.
All right,
Yes,
we're going to jump right in.
yes. Down payment assistance, that's the most topic that everyone that waiting to hear and to know more about it. So every year we have different type of down payment assistance come up, and also that depend on the need of the community. So the down payment from the government and from the bank will provide additional uh, fund for that. So I'm going to talk about community lending program. The community lending program requires 3% down payment program. So Wells Fargo provides 10,000 grant for closing costs. Bank of America provides 7,500 in closing costs and 10,000 in down payment help. PNC offer grant of 5,000 for down payment assistance or closing costs for first-time buyer. Alternative credit evaluation is mean that if you don't have a credit history, we can use the um, phone bill, the insurance, the car insurance bill, and the rental receipt that we need a verification from the landlord, so we can use that. But honestly, we rarely use that. Everyone know how to monitor their credit, so everyone is have credits. And flexibility on ratio, it depends on the down payment program. So they will be very flexible. So sometimes the program that some of the down payment assistance require 35% debt to income ratio. So it means whatever your income is, you only allow 35% debt to income ratio, include the mortgage, include the car loan or student loan or credit card. That's ratio A. And we also have the FHA and VA, VA for veteran and FHA mortgage. FHA is 3.5% down payment. VA is no down payment. This is a very good program for the veteran. And minimum down payment requirement for FHA, more flexible guideline than conventional loan, no income limit. Next one. And closing card assistant, what does it mean? Closing card assistant that provide offered by most of the bank and some of the down payment provider closing card assistant. You can use if you qualify and you get approved, you can use that grant or fund for the closing card to pay for a closing card when you purchase a home, or you can use it to buy down the interest rate if the interest rate is too high. You can use that either way. You can use it for the down payment also. And closing card assistant, they are lender provide. I just mentioned closing card assistant program. And you can use that. I already mentioned that toward closing cost for qualified buyer may eliminate upfront closing costs. No repayment required. Most when it say grant, it means you don't have to pay back, and can be combined with other community lending program. I will talk about later the down payment assistance program available in the area. Next slide, please. Yes, community assistance program can fund to assist with down payment and or closing costs provided by nonprofit, federal, state, or local agency. Repayment may be required or forgiven over time. Or Orange County down payment program, we have CAR is mean that California Associate Realtor, they provide $10,000 down payment grant for participant nonprofit. And I think that you have to use the realtor that, right? The realtor belongs to
Yes.
CAR, right? Yes.
Yes. Uh-huh.
And Couch Cafe, which is very popular right now. Couch Cafe has a Real for All program that offer equity sharing down payment assistance help. Check the website for more detail. And the program requires you to attend the home buyer workshop and the counseling section and another counseling section with the Couch Cafe. So you have to get 3 certificates to apply for this program. Check the I can see the bottom of it. It's too small. You
Check the city or county you're looking to buy in to
okay?
look for local
Yes.
programs.
Also, that some of the down payment provided by the city, by the counties. I will talk about those next. The fund assist with down payment and closing costs provided by federal. I have to repeat that again. So, a state or local government agency for nonprofit, repayment may be required for second loan or forgiven over time if it's grant. And some example is 120,000 from the city of Sanna is the fund. So you have to pay it back. It's deferred for 30 years. So the first 30 years you don't have to pay it back. But after when it's due when the year of 30 years, so you have to pay it back the full amount, 120,000 with no interest. But right now the program ran out of the money. Hopefully they return at in the I hope that in the midsummer, because they need more money to help people. And right now, City of Garden Grove offering 110,000, and this program is very good. You have to buy in Garden Grove, and the process is a little bit different. You get a pre-approval from the bank, and you also need to get a pre-approval from the city of Garden Grove. And when they approve you, then you have 12 months to look for the property. You have 12 months to buy the house, or or else they have to take the money back to give it to someone else. And the money will reserve for you. So as soon as they give you the pre-approval, it means that 110,000 will reserve under your name until 12 months. If you cannot find a home, then they have to take it back. And right now it is very popular right now in Orange County, the city of Garden Grove, they're very busy too. 60,000 from the city of Chino, 100,000 from city of Menifee, interest fee, and 15-year deferred loan. And I spoke with Doris. She mentioned that one of her clients get the down payment assistance from City of Menifee, include with BMO 20,000 closing cost grant. So she got 120,000. So that's Doris shared with me yesterday. And also that you can check with the city of Menifee. You can contact them or check their website. I know that they still have the money. And 101, 66,000 of the San Diego County. Yes. Next slide, please. City of Anaheim. Yes. City of Anaheim, 50,000. And it differs for 30 years, no interest. You have to contact the city to put your name on the waiting list. And we will provide a workshop with the city soon, and you can check with us for the update. If you live and work in the city of Anaheim, you should apply for this program. This program is very good. It's a 50,000, but um, it's very good. You can live, if you live and work in the city of Anaheim. So that's the priority for people that work and live in city of Anaheim. Yes. Next slide, please. This is a very popular program, but right now I think they ran out of money. It's a middle income down payment assistance provided by Federal Home Loan Bank San Francisco. And you must be a first-time buyer, up to 50,000 grant. You have to contribute of your own money of $10,000. All money, it means your own saving and not from gift. They won't take gift. And you have to use the grant for the down payment and closing costs. Income guideline restricted. Yes. Next slide, please. Yes, 100 Finance Loan Program. Community Opportunity Mortgage by First Citizen Bank. First time buyer only provide 100% finance with a $10,000 grant. No mortgage insurance, no PMI. Maximum income guideline apply only $500 required from borrower on 100% LTV loan. Credit guideline. Minimum 660 credit score for 100% loan to value ratio. This is a very good program. Minimum 640 credit score for 97% loan to value ratio and 45% debt to income ratio. And let me see the I don't know why, but
It's uh, it's 2 months of payment reserves.
yes, 2 months of
Must
payment.
be, yeah, you must have at least 2 months of payment reserves.
Yes, they need you to have that reserve. It means save it. You have to save at least 2 month mortgage. Next slide, please. And this is Couch FA. Couch FA, I would say the expert A, Doris. She's very good at this, so I will give it to Couch FA program to Doris. She will take over and she will talk about this.
And I'm back. You guys are stuck with me.
Welcome back.
So, College FA, I would say it's probably one of my favorite programs. It is a state program, so the funds are always available. That is the best part. And this program, I use it myself a lot whenever I have a client that doesn't qualify for any other down payment assistance program. Why? Because a lot of down payment assistance programs are going to be based on either the city or the county or maybe income limit. Maybe you make too much money, right? Or maybe even the family size. Those are going to be, the key points to qualify for down payment assistance. So whenever I have clients that maybe make too much money and maybe they're single, maybe they don't have a big family, this is a program that allows me to combine. I know Connie said speak on the layering, and this is where the layering becomes a key point in the qualification process. Why? Because the Half of My Home has different programs. The one that I provide to my home buyers is Kalhafa My Home Assistance, which it has a deferred payment. The best part is that you have 30 years. You have to pay it back. You have 30 years to pay it back. When you pay it back, you pay them whatever 3% they give you with a 1% simple interest. On the meantime, there's no payment in those 30 years. And these 3% can be layered with our grants. So, in combination between Kalhafa in my grants, we can potentially get to a 5% down payment, plus whatever money you may have, plus whatever money we may be able to get from a seller. So this is how we get to use a lot of, Kalhafa My Home for clients that are not pretty much qualifying for anything else. So it really comes in handy and it comes to save a lot of my clients. Um, it says right here, half a forgivable home equity loan, a builder loan. So he offers a down payment assistance loan of 10% of the purchase price and forgivable after 5 years. I encourage you to visit their website so that you can learn about the different programs that they have. I don't know if any of you have heard of the Kalhafa Dream for All program. The program is actually going to be rolling out in, I want to say February, and we are going to be sponsoring that program. There is going to be a lottery ticket again for it. So definitely check out their website when you can, so you can learn on it. Like Miss Helen said, yes, you must attend a home buyer education and get a certificate. And as a lender, as a bank, we provide you with a link so that you can get it, and it's online. Again, it's a resource that's always available. Somebody asked earlier how long or what makes you a first-time home buyer. It's the same requirement with Call HFA, My Home Assistance. It is at 3 years. So if you own a home 3 years ago and you no longer own a home and it has been 3 years, you qualify. Another good thing about CalHAFA is that if you own a rental home and you have been renting for the past 3 years and you have not occupied the home that you own, and we can prove that, then we can actually use College FA to help you for down payment assistance. So I thought, oh my God, this is something so neat to use for a lot of my buyers. And I want to say we have a flyer on the next slide, if I'm not mistaken.
Yes. And one question we had is there a threshold on assets to qualify for these programs? Like how much can you have like money in the bank? Would you still qualify if you had some money in the bank?
So if this is for Call HFA, it doesn't matter. As a matter of fact, you could do a 5%. Let's just say an example. We can get the 3% from them. We can get the grants from BMO, and we can potentially get to a 10% down. Or you may not have to use any of your funds. So it doesn't really matter how much you have in the bank. However, if it's for a different down payment assistance, I think Miss Helen will probably be the best person to answer if it would matter if you are applying for a different down payment assistance. Can you help me with that one, Miss Helen? Would that matter?
With the down payment assistance,
Like right, like example, City of Garden Grove. If somebody has 100,000 in the bank, example, and they only want to use, I don't know, 30,000. Would the City of
uh,
Garden Grove require higher down payment?
no, actually they don't. They will ask that they only require three, maximum is 3% to 3.5% contribution from the buyer. But like I say, the more the better, and you will pay the mortgage less if you put more toward the down payment. So most of the time, I would suggest them to put more money toward the down payment, and their monthly mortgage payment will be less. But
Lower.
it's still up to it will still up to the borrower. But to make the application look good, I always suggest my client to put more down payment. Yeah.
So really everything comes down to affordability, right? What you're
Yes,
comfortable with
yes,
paying, number
yes,
one. Number two, it does look good when you have, a higher down payment, but it doesn't stop you from getting approved either. So it's not a requirement. So that's the answer. It's not a requirement.
yes.
And so this is one of my College FA flyers. The best thing about this program also is that it doesn't require you to put a certain percentage out of your own funds. It can be as little as $1,000, really. Again, as long as that payment is affordable, as long as another good thing with this program is that we were talking about ratios. We were saying how some programs may qualify 43%. With Call HFA, if you have a 700 FICO score or higher, they allow you to use up to 50% of your income. So that's another reason why sometimes I may have a client that doesn't qualify under another down payment assistance because of the ratios. So this program comes in very handy, and it allows me to use a higher ratio up to a 50%. So definitely something good to consider. And again, it can be layered with other grants that we have to where you may be able to combine our grants called HAFA, seller credit, your own funds, and we may be able to do a much higher down payment as a whole. Another great thing is it doesn't limit you to any city. It is a state program, so it's California only, but it can be in any city, any county in California. This flyer here is just a representation of all the different grants that BMO has that pretty much layers all of it combined. And if this is the obviously this is I want to say on a $750,000 purchase to where we may be able to layer up to $47,000 in combined funds. So it's definitely great. Um, I had a little something here to share. Are you okay with that, Connie?
Yeah, sure.
Yeah. Okay. So this is just pretty much, I wanted to share what a closing or loan estimate looks like and how it
Oh,
looks. Is
I
that okay?
think yeah, I think hold on. I think we have a sample in here. I'm not sure. You can put it in the chat, but we do have one. Like there's a loan estimate, a
Okay.
sample loan estimate.
Okay. Hmm.
If you want to talk about that, and then I think I have a closing. Yeah, there's a closing disclosure too.
Gotcha. No, I was just gonna show just what it looks like on a closing disclosure, the layering aspect.
Oh,
Like,
okay.
but no, we don't have to do that. It's
Well,
okay.
if you can put it in the chat, you can go ahead and share it that way. I'm not sure how I would share it on the on this.
I see. No, I won't be able to put it in the chat, but
Ye-
maybe next time
okay.
we'll have
Okay.
something.
Well,
But anyway,
yes.
I hope I cover, all of the a lot of the programs that Miss Helen presented are supported by BMO, and I gotta say, Miss Helen does an amazing job at helping all the buyers qualify for the down payment assistance. And in combination, we have done a lot of great stories for clients that have gone into their home. So that's all I got.
Okay. And any questions for Doris before she pops out of here? I thought you answered a lot of great questions.
There was a lot of good questions.
There was a lot of good questions. How about talking about like if they, let's say I want to buy a home with my husband and my friend, because we
Okay.
need like all three incomes. Is that possible?
That is 100% possible. And that's a great question. I'm actually helping um, a family right now of three. So it's three different families buying their first home. And we are using five different applicants and we are using College FA. So, yes, it's
Okay.
very possible.
Oh, very good. Yeah. So each person would fill out an application, each person's credit and all that would be required, right? And their
All of
income.
that stuff, yes. All of the income will be required, but part of the process is deciding, okay, well, who is gonna apply, right? Who
Mm-hmm.
has, the good credit, who has the consistent income, because that's always gonna be good in an application, having consistent income, for the last 2 years. Do we have the credit that's needed? The person that has the lowest debt, right? We talked about that. So all of that is going to determine, who should be applying for that loan when it comes to, various applicants.
Okay, perfect. Thank you, Doris. And if you do have other questions for Doris, no, not a problem. We'll get those questions over to her, and she'll be happy to get back to you with those answers. But thank you so
Absolutely.
much for joining us today. That was great information, and we're going to continue on here on our
Thank you for
down
having me.
payment. Okay, thank you again.
Thank you.
Thank you, Doris.
Okay, and Helen, if you want to go over the Wish program.
Yes, this is the WISH program is very popular program, and they popular because they forgive it after 5 years. And right now they ran out the funnel. So every year, if you want to apply for this program, every year to have the grant will come in April, and they run out fast. It take about few months, and by the October everything is they use all up the money. And let's see, right now they offer 30,000, and it's forgiven after 5 years. Means you have to live in the house for 5 years in order for them to forgive that grant. You can use that grant for the down payment for the closing cost, either the down payment or closing cost is up to you. And a lot of people qualify for this program, and this is very popular too. And this program requires you to attend the home buyer workshop. All the down payment assistance, include the city down payment assistance. They require the borrower need to take the home buyer class, the 8 hour one home buyer class to get a certificate. But also, the borrower or the applicant need to attend the one-on-one housing counseling with the counselor to understand the process of the down payment, and understand how the city work and how the mortgage lender get involved, and what is the most important step during the transaction. So that's very important. I encourage everyone should take the home buyer class before apply for those programs. Next, please. This program, GSFA Platinum, is honestly, this program is a very unique program. Only that you work with the lender, you ask them about this program, or contact the state agency directly, like HFA, contact the state of California directly how to apply for it. And yes, the best way to contact the state of California, the housing department, and apply for this program. Next, please. MCC program and mortgage credit program that usually I know that only City of Los Angeles offering right now. And if you want to buy in Los Angeles, there's a City of Los Angeles. Los Angeles County is different, but City of Los Angeles offer this program, mortgage credit. And City of Los Angeles offer down payment assistance too. But you have to apply through the City of Los Angeles. And yes, this program is very good. And sometimes uh, I spoke with one of my clients. She combined two, actually three down payment assistance. The City of Los Angeles down payment assistance, 110,000, and then the mortgage credit, and then the closing costs from the bank. So total, she got almost $166,000 for the down payment. But they require that you have to buy in the City of Los Angeles. Yes. Next, please. VA home loan. This is require no down payment for the veteran, and usually that you have to work with the bank that provide a VA loan. And yes, to see how you eligible to apply for this program. And this program, I would say that most of the veterans I spoke with, they like it. Even my neighbor too. He bought a house with no down payment, and because he's the VA, and he got a very good interest rate too. And you have to we have to review your eligibility to see if you qualify. It depends on uh, the active service, how many days you active in the service, and how it depends on your situation. And then we will counsel you, and we refer you to the lender. Yes, next please.
All right, I think you're done there.
Question.
You're
Yeah.
all done, yes. But yes. Thank you, Helen, for that. Great information on down payment, and Helen will be with us the rest of the workshop if you have questions about down payment. So a lot of times people ask, is there a tool that I can help me find down payment assistance programs? Helen.
What the question again?
How can I find down payment assistance programs in my area?
Which area? I need to know which area because it
Oh,
depends on the area too.
well,
I need
I
to
was
know the
just saying,
county because each county they have different program, different guidelines, and some of the county they already ran out of money. And yes, if you need to know, you can email me, and so tell me the area, tell me the city or the county that you're looking for. So I will provide you the detailed information of the down payment available in that area. Yes.
yes, Helen is the wise one who knows about all the different programs and whether they have money or not, because you may
Yes.
find a great program, but like the city of Santa Ana is out of money. So, but don't get discouraged because then there's other programs like College FA. So there is a tool on eHome, which we do offer eHome, but you would have to pay $99 to take the home buyer class, but you're taking it for free tonight. But you can go to ehomeamerica.org down payment tool and put in where you'd like to buy, and it will give you a list of different programs that are available. But the best way to do it is to really work with your housing counselor, and then they can help you with determining whether or not they have that program has funds. Thank you, Helen. And as I said,
Thank
she's
you, everyone.
available. If you do have questions, feel free to put them in the question box, and we'll be happy to answer them. So we're going to speed through here. So we talked a little bit about the various loan types and down payment. So now you're ready to go shop for a lender. So how do we shop for a lender? So of course, you can check with your local College FA. You can talk to friends and family. You can read reviews. You could shop with your bank. We usually say, hey, go to where you store your money and check with that bank and see what kind of programs they may offer. Always make sure that the person is licensed through the NMLS. You can look them up, make sure that they're licensed. But there's mortgage companies, banks, all kinds of places where you can get a loan. It's a good idea to go with people that you know were referred to, that you trust, right? And it's a good idea to go to three. You're going to want to compare important cost information like the rates, buy down points, down payments, private mortgage insurance, fees, monthly payments. And these things will all be listed on the loan estimate that I think Doris mentioned really briefly. But when you first go to a lender, they're going to give you a loan estimate. It's going to tell you this is how much you're borrowing, the loan amount, your interest rate, how much your monthly payment is, if it includes escrows, if there's a prepayment penalty, if there's a balloon payment. This form will basically tell you everything you need to know about the loan and what the cost is going to be. Does it include taxes and insurance? Most of the time, it's going to include that. Does it include HOAs, Mello-Roos, anything else? It's going to tell you how much you need to come into for closing costs. So the loan estimate replaces the good faith estimate. It used to be called back in the day good faith estimate, but this is an estimate of what your charges are going to be. So it's a good idea to go to three lenders and get an estimate and see what everybody is charging. Question them about the fees and negotiate with them. Ask the lender or broker if they'll waive or reduce one fee. Make sure they're not lowering one fee and agreeing, to add a fee someplace else. Make sure that the lender or broker is, giving you the best deal possible. Once you're satisfied, ask for a written a lock-in to guarantee the rate, the period of time, and the number of points to be paid. If you have issues with your credit, ask what do I need to do to improve it? Do I need to pay off that bill? Do I need to pay off that collection? What do I need to do to increase it? Hopefully you'll be working with a housing counselor and they will go over this information. And at Get Credit Counseling, as I said, we're going to try and get you to the highest score you can possibly be at so that you're in the best position to get the best rates. So the loan process, you're going to do your research and education, then you'll fill out a loan application. You'll get pre-approved. It'll then go for processing and underwriting, and then you'll get approval and loan closing. So during the research and education stage, you're going to sit down with your housing counselor, review your affordability, and determine if you're mortgage ready. So there are signs to tell whether you're mortgage ready. Helen will tell you. You're going to talk to your friends and family. She'll tell you you're not ready. You have an $800 car payment and you got to pay that thing off, okay? Because that's $800 we need for your housing payment, okay? You're going to talk to the mortgage professional. You have no commitment at this point, right? You're going to just do your research. You're going to go online, do some calculations, see how much you can afford. Of course, Homeownership OC offers personalized counseling session. And after this class, you're going to do a one-on-one session with Helen so you can figure out if you're mortgage ready and how much you can afford. Next, you're going to go through the loan application. It has 10 sections and it asks lots of information about the property, yourself, your income, your assets, liabilities, all of that good stuff, right? Then once you submit that application, you're going to get a pre-approval or a pre-qualification. So what is the difference between the two? So a pre-approval is a written commitment from the lender or the mortgage funding as long as certain conditions are met. All of your information is verified and it takes more time than a pre-qualification. It does carry more weight than a pre-qualification, and pretty much before you go out with the realtor, they're going to want to know how much are you approved for and where's your pre-approval letter. So if you get pre-approved for 500,000, they're not going to go show you $600,000 houses, okay? Pre-qualification is a real quick, easy estimate of how much house you can afford and how much money your lender might be willing to loan you. The information is not verified. It's pretty quick. It's a 15-20 minute thing. It goes fast, okay? But that gives you an idea of how much you might be able to qualify for. Pre-approval is a little bit more. They're going to ask you for your income records, pay stubs, W-2s, tax return. They're going to want to document everything, prove any undocumented income, and look at your credit report, okay? So pre-approval holds more weight, and that's what you're really working towards. So loan processing and underwriting is where you submit all this information. The loan processor works with you to submit all this information, orders a credit report, an appraisal, verifies your employment, rent, bank account balances, all of that, and then gives it to the underwriter who reviews your application and decides whether or not you're approved for the loan. Next is loan approval and closing. So if you're approved, the lender sends a commitment letter and it formally states the amount and the terms of the loan. On closing day, when your loan is completed, you want to make sure the closing disclosure, which looks very similar to the loan estimate, that all terms are similar to the loan estimate. You're going to sign your documents, agree to pay the lender for the money borrowed on the mortgage note, and then give the lender rights to your property if you fail to repay the loan on the deed of trust. So the closing disclosure looks like this, very similar to the loan estimate, going to list all the same things. So it should be very similar to what they had provided to you in the loan estimate. It will list all of the fees. And if there's anything questionable on there, you could certainly call your counselor and say, hey, what is this? And you should question. You should ask your loan officer if you don't understand something. If the loan is not approved, make sure to review the underwriter's decision with your mortgage professional. And a lot of times the reasons for denial can be you change your income. Maybe you were constantly getting it overtime and now you're not. Maybe you change jobs. Maybe there's new debt or insufficient assets. Another thing that can happen is the value of the property is less than the original agreed purchase offer. So let's say you agree to buy the house for $400,000, but the appraisal comes in for $390,000. That would mean if you want to purchase that house and you said, I'm going to buy it for $400,000, you'd have to come up with that $10,000 difference. So, or let's say back when there was no inventory, there were bidding wars, and say they offer it for 400,000, but you can only get the property if you offer $20,000 more, 420. But the appraisal's only valued at 400, you would have to come up with that $20,000 cash out of your own pocket. So that's not happening so much anymore. There's not really there's more inventory on the market, so we don't really have those bidding wars happening, thankfully. Now, what is predatory lending? Predatory or abusive lending that combines certain loan products, practices, or prices that create unfair terms for the borrower. It can include packing or padding costs and fees, deceptive practices and fraud, high pressure sales tactics. Please don't sign any blank documents or anything you don't understand. Come to your housing counselor, come to me, question, watch out for anything that sounds too good to be true, because it probably is. We had a client that came to us with their loan estimate, and it had a $5,000 termite inspection fee. And $5,000 for a termite inspection fee that's normally free would be that's called a junk fee. Okay, we're just making $5,000 on this loan. So that person went back and said, hey, what is this? And no, I'm not paying that, right? So you got to look at that closing disclosure, the loan estimate, and make sure that you understand all of the terms that are on there. And again, ask questions if you don't understand. All right, so we're into the phase of shopping for the home, which is the fun part. You get to work with your real estate professional. There's a couple different types of agents. So we're going to have the listing agent that legally represents the seller and is paid by the seller from the proceeds. And then we have the buyer's agent that's legally represents the buyer, and it's usually paid by splitting the sales commission with the listing agent, or sometimes paid directly by the buyer. There's also what's called a dual agent, where they legally represent the interests of both the seller and the buyer in the same transaction, and may be paid by the seller, the buyer, or both, generally from the proceeds of the sale. So, seller represents the person selling the home, buyer is the buyer for the property. So how do we find an agent? Do your research, talk to people, talk to friends and family, get referrals. You can search by online, looking for areas. You can also see, maybe when you go out looking for houses, there's people representing the property for sale. You can go to realtor.com, the Orange County Association of Realtors, San Diego Association of Realtors, or, Riverside. They all have associations. You can also check out reviews on Zillow, Redfin, Trulia. Also go to the Department of Real Estate, make sure they're licensed, make sure they don't have anything on their credit. Check if they're a member of the Association of Realtors, but do your research on those things, okay? You also want to work with somebody who works with first-time buyers, if you're a first-time buyer, because they understand the programs. And those there's a little bit of a niche in working with first-time buyers and those programs. I would say interview at least 3, come up with your questions, your checklist, make sure you feel comfortable with them, make sure they're responsive. We've had clients call us and say, my realtor's not calling me back and they're not answering my questions. Well, that's not a good realtor, okay? If they're not responding to you. You were going to say, go find a new one, right? Ask them, how are you getting paid to represent me? You do have to have those conversations with your realtor prior to going out and looking for properties. So discuss your needs and wants, do your research. They're going to do the research on potential homes, come up with a list. They'll also give you access to those homes, help you prepare the purchase agreement and negotiate for you, and refer you to other professionals such as inspectors. They'll also provide a disclosure regarding their real estate agency relationship and fees upfront. And they're going to represent and negotiate for you as the buyer in this transaction. So make sure you talk to them about their compensation and how the fees are going to be paid. And are they going to ask the seller to pay for their fees? Because you do need to have those conversations prior to going out and looking for a property. You're going to sign a written buyer agency agreement before you go look at houses. Before signing this agreement, you should ensure it reflects the terms that you have negotiated with your agent and that you both understand what's happening here and what services and value will be provided and for how much. Written agreements apply to both in-person and live virtual home tours. And you do not need a written agreement if you're just speaking to an agent at an open house or asking them about their services. But if they're going to go show you properties, you do have to sign a written agreement. The seller may agree to offer compensation to your agent. And for the most part, I think that is what is happening now. I know there was a lot of talk after the NAR settlement, but basically things are staying the same. It's just all disclosed now. So the buyer's agreement must include 4 points concerning compensation, a specific disclosure of the amount or rate of compensation to the real estate agent will receive, compensation that is objective, such as a flat fee, a percentage, hourly rate, whatever that may be, it's all going to be disclosed. A term that prohibits the agent from receiving compensation from brokerage services for any source that exceeds the amount or rate agreed to in the agreement with the buyer. So if they agree to do it for this price, that's what they get paid. And then a statement that broker fees and commissions are fully negotiable and not set in law. So you're going to sit down with your realtor prior to and negotiate that. Be mortgage ready, be respectful, ask your questions, communicate with your agent. If it's not working out, find a new one. Okay. There's no that you know, you're not married to the person. You should feel comfortable with that person and they should be working for you to find you the right house. So there are different types of homes. We have single family detached homes, duplex, triplex, fourplex, planned unit development or a PUD, townhouse, condos, and manufactured homes. So you want to know what kind of property, like if you're going with a condo, there is going to be HOAs, right? And you're going to want to do your research on those HOAs because there's a lot of problems with HOAs and, the fees and qualifying for FHA and VA loans too. So you're going to talk to your realtor about that and they're going to show you properties that are in your price range. And they're also going to show you things that are you're going to qualify for. So there's different types of listings. There's a regular sale, traditional sale. There's short sale foreclosures. So we haven't seen too many short sales because most people have equity. Foreclosures, not too many of those, thankfully, as well. Or real estate owned where it's owned by the bank. So looking in neighborhoods, factors you may want to consider is the safety. Go to the neighborhood, check it out, drive around at different times during the day. See if you get a feel for it. Check out the conditions of other homes. Look at schools, the quality, the distance to your job. If you live in Orange County, but you're buying out in Riverside, make sure you do that commute and make sure that that's going to work for you because you could be spending a couple hours a day on the 91 going out there. You're going to want to make sure that it's doable. Look at parks, recreation, public transportation, shopping, other things that are important to you. Make sure you come up with a wish list. Decide on what you want and what you need, right? Those are two different things. So what we want is a dream home, but what we may be able to afford is just the basics, right? So it's our home for right now, and we'll work up to the dream home. So what is the must-haves for you? And what's on that list? And then the neighborhood, check out the neighborhood, make sure that it has strengths and weaknesses, and that you decide what's most important for you. There's lots of online tools to do research on the neighborhoods, Neighborhood Scout, Street Advisor, Crime Mapping, Megan's Law, Home Fair. There's lots of stuff. As I said, drive the neighborhood different times. Just make sure that it's going to work for you. So now we're out to house hunting. Your realtor is for the most part going to give you the list of properties, but if you just want to get an idea of what properties are costing in those particular neighborhoods, you can go to realtor.com, Trulia, Redfin, Zillow. They all have great little search tools. You can view homes by driving by, open houses, make sure you're respectful. Don't show that you've fallen in love. This is your dream home. You can do some virtual tours, search online. Your agent should be looking for open houses for you. Take your camera, take pictures, write down the pros and cons, maybe bring your spouse or friend, family members to look at it so you get an objective view and view it at several times and different times during the day. Check for any issues like water where it shouldn't be, paint peeling, cracking, structural problems, finish problems, building lines that aren't straight or true, utility system problems, because those could cost you some. Anything that looks out of the ordinary. So once you do find your home, your real estate agent is going to present an offer. It's a written purchase proposal signed by you and anyone else that will be part owner of the property. Before making an offer, make sure you've been pre-approved for your loan. Find out how much is it going to fix this house. Does it need a new roof? Does it need all new plumbing? Can you afford it? Does this home meet my needs and wants at the fairest possible price? And how long has it been on the market? If it's been on the market a long time, that could be a red flag. It could mean that there are some hidden problems there. So the purchase contract is a contract. It's going to include some important information, your legal name, make sure everything is spelled correctly, the property address, the price you're agreeing to pay for the property, the approximate number of days you'll be in escrow. Usually it's 30 or 45 days. And then you're going to sign it and agree to all of the terms on the contract. And then the negotiating starts. So you submit that offer, and then there's 3 possible outcomes. Number 1, your offer is accepted. You're going to escrow. Great, they agreed. Number 2, the seller sends a counter offer. Then they start negotiating back and forth. Or 3, the offer is just outright rejected and you decide whether you want to submit a new offer if it's allowed by the seller. So this is all the work that the realtor is going to be doing. So when negotiating, know your limit, know that your offer you settle on is the mortgage you will have to live with. So you can't go over your budget. So let's say they accept your offer. Now you're in escrow. So escrow is a licensed escrow company or an impartial third party that's going to hold all the funds and then disperse them. Make sure all parties are paid and all of the contingencies are satisfied. So escrow will be opened. That's when the period between the offer is accepted and the loan is approved, closed, and the deed is recorded. So within 3 business days of escrow opening, you're going to offer your earnest money or good faith deposit. That money is paid as a deposit on the home, and it's usually 1 to 3% of the purchase price. If the sale is successful, the earnest money goes towards your down payment. Within 7 calendar days, they're going to give pre-approval letter to the seller, verified down payment and closing costs. And then within 7 to 17 days, you're going to do all the inspections, review reports, disclosures, request repairs, and remove any contingencies or cancel the sale. So what are contingencies? Those are events or tasks that must happen before you or the seller can complete the purchase. If contingencies are not fulfilled before closing, the sale is canceled and you get your earnest money back. Typical contingencies would be loan approval or financing. If you didn't qualify for the loan for some reason, you could get out of the deal. The appraisal didn't come out in at the appraised price. Home sale. So it's maybe I'm selling one home to buy another home. That would be a home sale contingency, or there's title issues. So make sure you discuss these contingencies with your realtor to make sure you can get out of the deal if any of these things happen. So let's talk a little bit about the difference between a home inspection and an appraisal. Home inspection evaluates the structural or mechanical soundness of the property for the buyer. So that's something you're going to get. The appraisal determines the property's fair market value for the lender. Home inspections are very important. It's a professional looking at the condition of the home, writing a report. It may change your decision as to whether or not you want to purchase the home. It could save you money on possible problems you didn't see, and it reduces any chances of costly surprises once you purchase the home. So it's important that you find a reputable home inspector. Usually your realtor will work with them who may be part of these home inspection organizations. It usually costs between $300 and $500, and you are going to pay for this out of your own pocket. It's a small investment. It's highly recommended. Don't ever waive your right to an inspection. It's a good idea to meet the inspector at the property, ask them questions. It's very important that you review the inspection report with the inspector, go over any of the things, because then you can request repairs and things that may need it, that the property may need. So red flags would be environmental hazards, water contamination, asbestos, lead paint, underground storage tanks, moisture in the basement, defective roofing or flashings, insect infestation, termites, chimney settling. Those are all really big red flags, and you're going to want to know how much is it going to cost to fix these things. That's when you would negotiate. HUD wants us to remind you that it's very important for you to get a home inspection. Don't waive your right to a home inspection, as it's got a little bit of money up front, but it will save you in the long run. You're also going to get a title report and title insurance. Title report is a legal document from a title company, and it includes a description of the property and any applicable liens on the property. You should review this with your agent. And a title insurance policy insures the lender or property owner against defects in title or challenges to their interest in the property. Closing task, you're going to do a final walkthrough with your agent and verify the condition of the property. You'll use a final walkthrough inspection checklist. You'll do this with your realtor. You're going to purchase homeowners insurance. You're going to obtain a copy of the closing disclosure, sign loan documents, and provide down payment and closing costs to escrow. Escrow closes when the loan has been funded, and escrow notifies all the parties that closing has happened, and they're recording the title, and you get your keys. So that would be the closing process. Any questions? Feel free to put them in the chat. Let me see if there's anything that came up here. My lender wants to charge me a fee for the 3 credit reports I can get for free. Is this the same information she gets? Is this info she gets not the same? So, the credit report they're going to run is their own credit report. So if they are going to charge you, yes, you do have to pay a credit. It's either going to be upfront or it's going to be on your closing disclosure. So you're going to pay for it one way or another. And they do have to run their own credit unless you had, and maybe Helen can help with this one. If they've had a credit report within the last 30 days, can they take that one?
It depends on some lender they have to pull their own credit report. But usually the fee they include in the application. And some of the loan officers they would waive the fee if you do the loan through them.
Okay. Okay, so
Yes.
it depends. It can depend
Yeah, it
then.
depends. They won't take they won't accept the credit report from other agency or the bank. They have to
Yeah.
run their own. Yes.
Yeah, they usually have their own protocol though, or they have to run it. Is an inspection recommended for the purchase of a condo? Yes. Yes. Okay. Like I said, you do not want to waive your home inspection because it's looking at the property to see if there's anything. It will check the AC, the heating, the water, everything. Right, Helen?
Well, the inspection they will check because the condo they share the plumbing system they share with each other. So the most
Right.
important is the home inspector will check the plumbing system. before
Hmm.
they check the heater or the AC, and they will check the surrounding like the termite. Very important because most of the condo they always get a termite problem.
Yeah, there could be other things. So yes, definitely get a home inspection, even with a condo, because there could be water leaking in the walls or something, and hopefully a home inspector is gonna
Yes,
see that,
yeah.
right? Or if they tried to cover it up with paint or something. Very good questions, though. Very good questions. All right, we're in the home stretch. Let's talk about protecting our investment. Of course, you're going to have homeowners insurance or hazard insurance, which covers your home. It's required by your lender. It protects your asset in the event of structural damage. It pays to replace personal belongings within the home if they're stolen, and also provides liability coverage in case of accidents happening on your property. So coverage is usually covered fire, structural damage, liability, theft, temporary living expenses. You may have to pay for additional coverage for earthquake, expansive soils, floods, hurricanes, landslides, etc. And as we know right now, homeowners insurance is very expensive. Some insurance companies have left certain states for certain reasons. So you do want to shop around and find out how much that insurance is going to be. While you're shopping, there's replacement cost, which is the amount it would cost to rebuild or repair your home with similar materials, or the actual cash market value, which pays you for your loss, but often doesn't pay enough to fully repair or replace the damage. Shop around, get 3 quotes, make sure the company is licensed, ask questions, look for discounts as you bundle your auto insurance with them. And I know a lot of people that were impacted by the fires. The reason why they have not rebuilt is because their insurance does not cover what it's going to cost for them to rebuild their property. So if you're in a fire area, you may want to take that into consideration, right? How much is it going to cost you to have to rebuild this property? Because a lot of folks in the LA area are still impacted by that. There's also a home warranty, and which is different than homeowners insurance. So home warranty is optional. It covers plumbing, electrical, heating system, major appliances, and it can be between 250 to 500 a year depending on the coverage. Plus there's a call for the service fees, usually between $50 and $100. So when you're making a claim, you would call the home warranty company to explain the situation. They call the home appliance repair person who will come out and fix the appliances. All repair expenses are covered, but the warranty holder pays the $50 to $100 service fee. It's a good idea to get it when you get a home because you don't know what's the background. Homeowners insurance is different in that it's required for the loan. It covers damage if there's fire, theft, etc., what we discussed. Can be between 300 and 1400 depending on several factors, and they only cover the repairs. They do not hire the contractors or make the repairs. However, and they may not cover the entire cost. Again, homeowners insurance is required, home warranty not required, optional. Very important for you to remember that we're all protected by federal fair housing laws as well as state fair housing laws. We're protected due to our race, color, national origin, religion, sex, familial status, disability, and there's other protections under California state law. So if you do have questions or feel like you've been discriminated, feel free to reach out to us and we'll refer you over to our local fair housing agency. California fair housing laws are more expansive. It includes sexual orientation, gender identity, marital status, medical condition, ancestry, source of income, age, genetic, arbitrary discrimination. Again, if you feel discriminated, feel free to reach out to us. It does cover all housing, rental, the purchase, selling, insuring, appraising, lending, nursing home. Pretty much all housing is covered under the Fair Housing Act. And what is discrimination? It's really blocking someone's access to housing, treating a buyer or renter differently due to their protected class status, denying someone the right to buy or rent a home even though they can afford the property because that person is part of that protected class. Again, prohibited acts would include refusing to sell, lend, rent, represent the dwelling is unavailable for inspection, sale, or rental when it really is available, providing different terms or conditions, canceling or terminating the sale, loan application, credit, rental agreement, refusing to provide reasonable accommodations if you have a disability, or making threats, intimidation, harassment, or unlawful inquiries. All of those would be prohibited acts. In real estate, it would be lying or exaggerating sales terms, failing to inform buyers of all listings, stalling to avoid showing a home, running a discriminatory ad, or refusing to negotiate with prospective buyers, or steering to certain neighborhoods. Like, for instance, the realtor says a family wouldn't feel comfortable here because this neighborhood is mostly for professional adults. That would infer it's no kids allowed, right? So they can't say that. In mortgages, it could be scrutinizing one loan application more closely than another, or giving an unreasonably low appraisal value, imposing different terms or loan conditions, denying loans in certain neighborhoods, which is known as redlining, or targeting specific borrowers based on their protected class. Only Spanish speakers or Vietnamese speakers or Korean speakers, that would be targeting. Same thing applies for lending, refusing to provide information regarding all loans, steering them to bad or inferior loan products, offering different terms or condition based on their protected class status. Same thing, if you feel like you've been discriminated, feel free to reach out to us and we will refer you over to the local fair housing organization. There's also a difference between overt and disparate treatment. Overt discrimination would just be openly, or, we don't lend to single women would be a type of discrimination, whereas disparate impact is treatment of members of protected class are treated differently than others, and it can be unintentional, but it has an impact on them. Same thing, be aware of the signs of lending discrimination or in the credit process as well. The Equal Credit Opportunity Act, we're all protected under the same protected classes for that. So it makes it illegal to discriminate in credit and holds lenders responsible if they break the law. And it applies to all types of loans, not just mortgage loans, but car loans, credit card loans, home loans, student loans, business loans, from the person applies to the time the person pays off the account. Some examples of lending or credit discrimination would be rejecting a credit application based on their protected class, changing the credit terms or condition based on a consumer's protected characteristic, asking if the person receives alimony, child support, or separate maintenance payments, asking if they're widowed or divorced, asking about spouse's income, or refusing to consider public assistance income in any other way. Offered credit with a higher rate than they applied for, even though they qualify for a lower rate as well. Same thing with foreclosures, refusing to provide the same forbearance or workout terms to all borrowers, providing less favorable loss mitigation terms, denying forbearance to certain protected classes, or failing to explain available foreclosure prevention policies, or harsher collection or foreclosure practices based on your protected class status. Disabled buyers and renters are also protected, and they have the right to make reasonable modifications and accommodations to get full use and enjoyment of the housing. So everybody must abide by the fair housing rules and make accommodations if they are requesting it due to their disability. I'm not going to skip over this one so we can make sure we make it on time. Some safety precautions. Make sure you have all the emergency contact information. Make sure you do occasional fire safety inspections. Stay current on your smoke detectors and carbon dioxide notifications. Have a fire extinguisher in your home. Make an escape plan in case of a disaster and emergency. Make a preparedness kit. And at least install one carbon monoxide detector in your property. Also protect your home equity. Equity is the current market value of your property minus the amount owed on any outstanding mortgage. So let's say I owe 400,000, but my property is worth 600. That would mean I have $200,000 in equity. So it's an asset that will help you build your financial future. So when borrowing money using your equity, it's called a home equity loan. Be very careful in utilizing that equity. Just know if you don't repay that loan, the lender will collect the home as collateral. So you want to make sure whatever you're using that home equity loan for goes into the property. When you're purchasing appliances, you want to look for Energy Star programs and energy efficient programs. A lot of the electric and gas company will give you rebates or discounts if you utilize Energy Star programs or appliances. So make sure you check those out. And sometimes they give them to you for free too. So what comes next? You've come to the end of the class. So if you're already approved for a loan, you're going to forward your homebuyer certificate to your lender or ask Helen to send that over. If you're ready to get pre-approved, you're going to contact a lender, see how much you can qualify for, talk to your housing counselor. Not sure if you're ready or you want to learn more, meet with the housing counselor, do your one-on-one, and find out if you're mortgage ready or what you need to do to get mortgage ready. If you're trying to save up and improve your credit, again, meet with the housing counselor now. Even if homeownership is a year down the road, meet with them now to know what you need to do to improve your credit, improve your savings, pay down your debts, and make sure that you're mortgage ready. So be sure to complete your intake form if you have not done so, and you will have to do a one-on-one session with our housing counselor after this workshop, and then you'll be able to get your certificate. So make sure you go to homeownershipoc.org to complete that online intake form. For successful homeownership, you want to avoid any kind of risky loans. If it sounds too good to be true, stay far, far away from it. Make your mortgage payments on time. Stay current on your property taxes. Maintain adequate insurance. Know if you're somehow lapse in your insurance, the lender will place lender-based insurance on you, and it's very expensive, and you don't want that. So you want to make sure you keep up on your insurance. Keep your home in good shape. Keep an emergency ready in case you do have expenses that come up. Avoid borrowing against your equity for consumer purchases. And if you are having trouble making your payments, you come back to us and we will help you work out something with your lender. Come as early as possible. All right, so make sure you read all the documents, that you understand, you ask questions, know that you can get help from us at any time. Know your budget, stick to it. Make sure you check out your realtor at the Department of Real Estate. Make sure you check out your lender through the NMLS. Look for down payment programs in the city or county you're looking to buy in. Make sure you know what's available. If not, talk to your counselor. Shop around. You've done the great job of educating yourself today, which is the first step. So bravo to you all. All right, we're going to get to some questions. And as I said, if you didn't fill out the intake, make sure you do that at your earliest convenience and set up your one-on-one counseling session. All right, we have a couple of questions here. Let's see. As a prospective condo purchase, is there any different requirements? Let's see. Helen, you want that one? Are there any different requirements if you're purchasing a condo?
It's different. different based on if the condos in the flood zone, the HOA have to buy the flood zone insurance, or else the lender won't close the loan because that's a requirement by Fannie Mae.
Okay.
And also, if there are termites, the seller won't fix it, the HOA have to fix it. And if you apply for the down payment assistance, the down payment assistance program include the city program, the county, the government program, or the down payment assistance program. They require the buyer to provide a copy of the home inspection. They want to make sure the new homeowner live in a good condition, not a poor condition. Yes, that's very
Okay.
important. Yes.
Did you also want to talk about FHA approval and VA approval for condos?
I don't really know about VA condo, but FHA, the unit have to meet the FHA requirement.
So if it
Yeah,
doesn't, you can't have an
you can.
FHA loan in there,
So
right?
where if you get the FHA loan, when you shop for a home, you need to talk to your realtor. Make sure the house that you like, you send the address to the loan officer to tell them to check if this is qualified for FHA loan.
Mm-hmm. Okay.
Yeah.
And how about gifts? Do these down payment programs allow you to have a gift? Like if I need extra money for closing costs?
I would say give. You need to disclose with your loan officer as soon as possible. Don't wait until the last minute. When you fill out the application for the mortgage, you need to mention that. And then the loan officer, the banker, will advise you what to do. But also, with the down payment assistance, include all down payment from the nonprofit to the government. Um, have to be very careful when it comes to gift because if they will say that if you have gift you don't need a down payment assistance.
Oh, right.
Yes, is it 1%? I think some of the down payment they allow 1%, but it's not like 20,000, thirty
Yeah.
thousand will be a lot. They won't take it.
Okay.
They won't accept it. They will say you don't need the down payment assistance.
Right.
Yeah,
Right.
yeah.
Right. So
So
just
it
remember,
depends. It depends. It depends. But we need to disclose when you apply for the down payment assistance. You need to the borrower need to disclose with the bank and the down payment assistance program that I may receive gift because my parents want to give me gift. If you really need it, then let me know so I can talk to my parents. Then from there they have the idea already. They put a note in their system say, oh, this person may get a gift from the parents. So they put a note of it and
okay.
they will guide you how to get a gift if really needed. If not, they will say, oh, you don't need a gift. You
Okay.
the down payment already covered.
Okay. Okay,
Yeah.
perfect.
You're
All
welcome.
right. I think that's all the questions that are in the question box at this time. So yes, I'm happy to share this presentation with you. I'll email it out. We'll also have a copy of it on our website. You're welcome to view it. It will be at homeownershipoc.org. As I said, don't forget to complete your intake. If you've already done it, great. If not, feel free to do that and then schedule your one-on-one session and then we'll get you your certificate. And good job for you all taking the class and getting educated. You've done the first part, so that this was like the starting part and the hardest part, but good job, and I give you all claps for that. We're here as a resource, so feel free to utilize us as a resource. We're happy to help you guys in your journey to homeownership. And thank you, Helen. You did an excellent job. I will send our thank yous to Doris as well.
Thank you, everyone. Yes.
And
Thank
thank
you,
you
Connie. Yes.
everyone for spending your time with us today. We appreciate that. Have a great one. All right, thank you.